Hey guys, it's Pump Fiction. I want to get into the real reason the rich keep getting richer from stocks. So let's get into it. Disclaimer, this is not financial information. This is only for educational purposes only. Read this if you're interested in any of that. It's not a conspiracy. It's really a system. The gap between the wealthy and the poor really isn't much of a secret at all. It's a lot of the knowledge out there is relatively free for the most part. You know, it's out there. You know, you just kind of have to look for it. You know, the wealth gap isn't always about secret knowledge. It's just the mindset that you have, the leverage you use your money, and a lot of it's out there. A lot of it is on the web, and if you use ChatGPT, you can find it on there. I wouldn't recommend finance advice on ChatGPT or internet articles, but or even mostly YouTube. But it is out there, and a lot of the information you can find for free. So I just want to go over that quickly. Now, this is a chart to show the stock market over the past 20 years. For the most part, the stock market has been going up year after year. I mean, we've been on a crazy bull run since 2015. Every year, I mean, since then, almost every year has been a huge upswing. I mean, over the past 10 years, I mean, as everybody can see, let me get my pen. Over the past 20 years, I mean, everybody could see it's literally just a straight line up for the most part. And the market's up almost 200%. And that's the general market. That's not even the outliers that have done really well, like Apple, Microsoft, Google, and Nvidia, and any of the other FANG stocks. So anybody that, hasn't been invested during that time has essentially missed out on a pretty big opportunity. I mean, the market has done so well, and if you haven't held anything and kept your money in cash or even CDs or something, you're probably looking at best, half that, with the interest you would get on those other products or your own personal savings account, which for most is like 0.1%. So might be just a flat line for those accounts. So, and that's the gap that really can bridge apart the poor from the people who are well off, so, and this goes into it. 90% of stocks are owned by 10% of people, not 10% of people. Well, yeah, 10% of the population. 10% of the American population owns 90% of stocks. So 90% of all the stocks are owned by the top 10% of people. So, and you can see on this chart, the bottom 50 don't even own 1% of the stock market. The bottom 50 doesn't really probably have the opportunity to do it either, but they own a significantly small amount. They and the next 40% owns 10%, which is significantly more, and the next 9% owns a lot more, and then the top 1% owns over 50% of all the stocks. So all the entire market, 1 out of 100 people own over 50%. So 1% own 50%. So that's a big disproportionate amount at the top. But then again, you have to kind of think, a lot of these people in these higher percentiles, they're thinking about this kind of stuff and focusing in on investing in stocks. So it's on their mind to do these sorts of things. And so investing isn't equal. People make different money. People have different disposable income. People have different amounts of money they can put in the market. Not everybody can put $1,000 into the market every month, or 2,000 or 5,000 or whatever crazy amount they can put in. Most people can't even do that, and most people probably can't even do $500 or even a couple $100 because of running razor thin um, margins, or razor thin amounts they have in their bank accounts, or just enough to get by, paycheck to paycheck. And so there's a lot of people out there that don't have the disposable income to do it. And so the people that can't do it don't invest in the market, and the people that can do it invest in the market. And the more that people invest in the market, the further the gap between them and the person that doesn't just gets wider and wider over time. And that really creates that disproportion between the two, and probably why that previous chart is the way that it is. Another reason can be financial literacy. And, that's because not everybody has the financial knowledge as to what to buy, how to buy it, or even if they should buy it, and there's a lot of bad financial advice out there. There's a lot of advice out there to not do the right thing, and that can lead many people astray, even if they do invest in the market. There's some people that do invest in the market, but get led down bad paths that get them nowhere. So, and also another advantage that more wealthy people have as well is that the access to financial advisors. A lot of people who don't have as much money don't have this access to financial advisors, or even know any, or where to even find one. So it kind of can also that can also be a hindrance too. And the last thing would be an early start. The people who are well off probably also teach their kids how to invest in the market and what to buy. And so if they're starting at 18, and by the time someone like me learns years later, I start a lot later than they would, the compounding for them starts a lot sooner. So, and the rich use stocks differently too. They understand the tax strategies. They understand reinvesting the stocks, putting money back into stocks, and reinvesting the dividends over time, and compounding that money on top of that money. If you put $1,000 or $10,000 into a stock, and it goes up 10% that year, but you also get like 2% in dividends, and you put the 2% back in, now you got 2% more, and you also have that 10% gain. And so that's another compounding feature that can just really, really snowball over time. And they also understand holding power, the power of holding over time and really letting your winners ride over the years, just hanging on to stuff that performs well and does well, holding on to your winners and just letting those ones ride. And this kind of goes into it. This chart essentially shows $100,000 earned at a job and $100,000 gained on a stock, and how they're taxed differently. So $100,000 at a job, this is probably just inferring, federal taxes, would be like a 24% tax on that, which would be $24,000 taken off the $100,000. Whereas the long-term capital gains tax, which essentially means that you hold a stock for more than a year, and that will qualify you for that long-term capital gain, and the tax on that would be 15%. So $15,000 taken off $100,000. So you're almost saving $10,000 going about that way. And this is one of the more simple ways as to how some wealthy people manage their money and save money on taxes in certain ways. But this just kind of illustrates, to show like $100,000 earned in the stock market is different than $100,000 earned for a job. So, and this next slide kind of goes into if someone were to start at 25 and if they had a 10% return per year, how much they would have at the end of 40 years for every amount invested. I have 4 of them on here. I have $100, $250, $500, and $1,000. And this pretty much just to show how much you would have in the end. If you put $100 into the market, you would have over $630,000 after 40 years, which, that's a lot of money for $100, every month. That's a lot of money. Maybe not in the future if inflation was considered into play. There may not be as much, 40 years from now, but it's still would be a lot. If someone put $250 a month into the market, that'd be a little over $1.5 million, which even with inflation, that still would be a lot of money and would help a lot of people out for retirement. They probably wouldn't be able to retire like forever for like 30 years off that. May not be able to. They might be able to, though, if they keep the money invested in the market and they took a little bit out of you. They might be able to, actually. But after that, I got $500 a month, which is over $3.1 million. So most people probably could live off that, even with inflation considered. Because inflation considered, that probably would take sadly, like 2/3 off that. So probably after inflation, 40 years from now, that probably really realistically be a little over $1 million with inflation considered in. So most people probably could retire with that over the last for the next 30 years after 65, assuming they live to 95. So, and then the last one, and I just threw it in for the heck of it and to kind of show you how much it goes up by. Someone put $1,000 in, they would get over $6.3 million. So after inflation, that's probably like $2.5 million or so. After inflation's included, after 40 years, and most people probably could live off that in retirement and be able to probably live a pretty good retirement off that. And an interesting thing is if you look at $100 and $1,000, the totals for each, the $1,000 is exactly 10 times as much as the $100. So the difference between $100 and $200 in the end is literally twice as much. So most people may not think, the extra $100 that month may not really be that big of a difference, but it is. In the end, it is, because it would be a difference between over $600,000 in retirement versus over $1.2 million between the difference between $100 and $200 a month. So, that's something to note. It's something worthy to know. So, and this is just a basic slide just to kind of remind people that the wealthy people buy assets. Buy stuff like Apple stock and, hold that over time, whereas, I don't want to say, poor, but, people who don't have as much usually waste money on expenses and just buy personal items. Now, I know this isn't always the case and whatnot, and it's sometimes a lot of time have to do with financial literacy, but it's just supposed to illustrate the point of the difference between, investing in an asset versus an expense, because sometimes people mix the two. Some things that people think are assets are really just expenses. So, and I kind of covered this earlier. This is another thing that well-off people understand, the power of reinvesting the dividends over the years. And this chart illustrates that a little bit. The different in this chart looks like they start at $10,000 in the beginning, and after 30 years, they they look like the blue one looks like it goes up to almost 60,000. Oh no, I lied, almost 80,000, which is without reinvesting the dividends at 7%. And the green line is with dividends, and that would total 9%, assuming a 2% dividend. And that puts it over 120, probably 130,000. So pretty much over a 30-year span, reinvesting that 2% dividend almost gives you twice as much money. Pretty close to it. Pretty close to twice as much for just reinvesting that 2% extra, per year or whatever. Or I would say whatever, but that dividend is. But if it's little, it won't do that. But in this case, a 2%, definitely a 3% will make you double that if you reinvest it. So, yeah. How the wealthy leverage stocks for income. Living off dividends. Not a whole lot of people can live off dividends just because dividend stocks don't move as much. But if you got a lot of value in them, you could technically live off dividend stocks. If someone holds $3 million and like a dividend ETF that's like paying out like 3%, yeah, they probably could live off that, But the contrary is a lot of people kind of get caught in this thing of, oh, I want to eventually live off dividends, so I'm going to buy dividend stocks. But the problem with that a lot of time is dividend stocks don't move as much as the general market. The general market typically moves a lot faster than dividend stocks, dividend ETFs. So that's kind of the con to them is that they're nice when they pay you out. It's nice to get paid out, but a lot of time, sometimes it's an incentive to buy the stock, and so that's why it can be kind of a con to them. So another thing most people don't have an opportunity to is borrow against portfolios. A lot of time, really, really wealthy people use a margin or lines of credit. This kind of gets more into the weeds of things of how like the rich can borrow off the stocks that they own, but that's something that they can definitely do, and what most people most likely won't be able to do, at least easily won't be able to do. So in this chart just kind of goes to show there's been so many times over the past 5 years as to when people absolutely panicked in the market. Over the past 5 years, like people like get in and out of stocks all the time. They get in something, they get out of something, they buy it, they get scared, they get out of it. But there's been so many times over the past 5 years where if you just simply held the entire time, you would have done really well. I mean, right here in 2020, when everybody freaked out, during the virus and whatnot, if somebody sold all their stocks right in the middle of there or anywhere in that circle, or during that time, they would have missed out on a big opportunity if they never invested back in the market. Or if they invested a year later, they would have been like way up here, and they would have missed out on a lot of gain. They would have missed out on a lot of opportunity. And even right after that, right in 2022, everybody freaked out right here, thinking that there was going to be the everything bubble right there. Everybody thought everything was going to pop right there too. But that didn't happen. Next thing we know, the market goes straight up. I'm not saying this happens every time. I'm just saying that people a lot of times get psyched out by the market. They get in the market, they get out of the market, and a lot of times, sometimes they get nowhere because of this. And also, this may not be something you want to do if you got a lot of gain, because then you'll pay taxes on top of that. And in most cases, this isn't financial advice or anything, but most cases for most people, just holding the S&P 500 for the long term, probably would just be best for them. and just not worry about the market. The best thing for most people probably to do is just buy the general market. Don't ever look at it and just keep putting money into it, because people who focus on the market and really look into it and like try to analyze everything and be like, okay, we're going down. Okay, I'll give you the most recent example. Right here, we had this big old drawdown right here when everybody freaked out about the tariffs. Everybody thought things were going to go down lower and lower. And so if someone analyzed that and looked into it, they would be like, oh man, I probably should get out of the market because everything's going to go down 20, 30%. And I might as well get out now so I don't keep losing money in my portfolio, and that didn't happen. The market completely rebounded and went straight up like 30% from the bottom, and all the people who sold there got left behind, And so for most people, it's most likely best to just buy the market and just forget about it, because there'll always be news about there'll always be bad news, and there'll always be something happening. There'll always be something. But main thing is for most people probably just to buy and hold the general market, and that probably help out most people, whether it's the S&P 500 or the NASDAQ 100. For most people, that's the easiest thing to do, and it takes a lot of headache out of it. So generational wealth starts with stocks. A lot of this is pretty much what I was saying before. Investing in stocks can be a passive thing. You can invest in ETFs, index funds that just track the top 100 or 500 stocks, and that's that. Whatever's in there, that's what you own. And that makes it relatively easy. You don't have to manage it. You don't have to buy and sell all these stocks you think they're going to do well, that you think they're going to do bad. A lot of that will be done for you. If you buy like VOO or SPY, which are the S&P 500 ETFs, they'll automatically track it for you. They'll automatically put in the stocks that are in the S&P 500 and take out the ones that aren't, and you'll always hold the top 500 stocks. So they'll help you out with that. And that was another thing I was mentioning earlier. The wealth teach their kids early about this, the market and how to invest and whatnot at a young age. Dividends, I mentioned that earlier. Even modest monthly investing creates I was mentioning that earlier too. So I went over a lot of this stuff in this slide, so we'll go on the next one. So to circle back to earlier, can most people catch up? A lot of people probably feel like that they're behind, and a lot of people probably feel like they won't be able to get ahead or get to these points in life to where they can feel a little more free, and I understand how a lot of people feel like that, and I get that. But this chart, I want to bring this chart. I brought this bring this chart up again. I kind of copied it from the one earlier, but I just want to show people that if you put in a little bit and give it time, it will do really well. Most statistically over the past 100 years, the stock market with dividends reinvested, stock market as in the S&P 500, tickers like SPY and VOO that track the S&P 500 index. Over the past 100 years with dividends reinvested, you get about 10% return. And so, and this chart shows over the next 40 years how these things perform, per dollar amount per month. And so it's just to show if you give it time, most likely, statistically, it will most likely do well over that time and compound over time and do pretty well. And the main thing is to get started early and get that snowball going, because as you can see right here in the end, it does snowball really, really well, even with a very small amount. And all these numbers are, all these numbers are based off starting from zero. So all these numbers, all these, millions of dollars that are listed on here are essentially based off of starting from zero. So if someone already has $10,000, it'll be a little more than what's even on here if you invest in the next 40 years. So that's a positive. But so this slide just pretty much shows that, the market doesn't care who you are, only what you do. So, if you do something now, it can make a big difference, later on. Putting off investing is probably one of the things that can set you back the most, because if you wait another 10 years to invest, it probably will cost you twice as much money to get to where you want to be, to make it to that number. Like if it costed you $100 now, it's probably going to cost you $200 or $300 10 years from now to make that certain number by a certain age. So it's very, very important to get that little snowball going while you're young. So, and that's it. So if you guys like the video, please like and subscribe, and adios. See ya. Bye.